Hi everyone, welcome to one more session of knowledge from our side. My name is Sameer Singh Jenny, and I'm part of the Digital 5 team. This session is really experiential, so very little what we are going to talk is going to be very, document efficient, right? So you will say, "Yaar, ye aisa dikhta nahi hai," but it will be more of a experiential. So I'll be very happy if you could ask your questions as many as you want in the journey. So what I will do is every 10 minutes, I'll pause and you can ask your questions as you wish. So that's largely the intent right now today. Give you a perspective on how embedded finance is built. And in past something like 3 years, we have been working with a lot of clients in different segments. And one of the common thread we have realized is that people get perplexed when it comes to embedded finance, that how will you build, what is the process, what are the challenges, how do I engage with, say, a lending platform, how do I engage with maybe insurance companies and all of that, right? And sort of in this period of last few years, we have been able to create some framework around that. So that's what we are going to share today. And happy to take questions. So you can ask your questions on chat, and I'll respond back on that. Happy to take any questions after every 10 minutes to take it forward, right? So that's largely the intent. If you have some questions you would want to ask, you can share on chat, and I'll try to respond back on those questions as well. With this we start. I'll not spend too much of time introducing ourselves and all of that, but maybe a quick pointer, because many of you will be net new to our classes or sessions. Again, my name is Sameer Singh Jenny, and I'm part of the Digital 5 team. This whatever we are going to take a session is actually on based on the whatever learning we've had on our consulting side, since we work with a lot of embedded finance players. And this is also what we tend to teach in our executive certification program, which runs on almost on a quarterly basis. So again, the next one is starting in February, and in that thread also we sort of tend to take these courses as well. So it's technically is a course material from our classes as well, where we help in our participants to learn about it. It's typically built for seniors in the market. It's not really for students. It's basically for those who are either founders or who are like business heads, CXOs in their companies, trying to build their own businesses on various segments. So that's what we do: fintech, open banking, and financial blockchain. We'll talk about later. But right now, let's go forward. A quick one. We have been in the business. In fact, I explain myself as more like somebody who has built potentially more banks than most in the world. And I have been able to set up a PSU bank, a private sector bank, and also in a sense change the direction for a old cooperative bank as well. So have experience of that kind. And of course, we have worked in last 5 years with many fintechs in the market as well. And of course, today, small finance bank and smaller private banks, sector banks are our forte. But of course, we work with a lot of fintechs in the market. So that's our experience and thought process. We work a lot on consulting side, and we work with banks and fintechs and all of that, and bureaus and networks and everybody around that, and a lot of embassies as well, as they bring their foreign entities into India. We work a lot on partnership side to go to market. We do for a lot of entities in the market. Training, we are potentially one of the largest trainers in the world on fintech and open banking, and we would have trained almost 4,000 odd people in the country. And of course, we do very specific fintech oriented recruitment as well. So with this, I move on to the content which we were trying to sort of talk about. Now, embedded finance, I always believed that will be larger than any other business. I think this is, if you look at consistently the communication which has gone from our side, and maybe the blogging and all of that from our side, has been to say that over a period of time, maybe next 3 to 5 years, at least 40% of the business will be primarily on embedded finance side. And many of you feel ki aisa nahi, this is not possible. But let's just think about it. Today, in UPI, 90% of the UPI transactions are actually embedded finance. They come from other entities which are not banks, right? And UPI is controlled by banks, but all transactions from non-UPI, non-banking frameworks. It can be a phone pay, it can be a Google Pay, it can be Amazon, but it's coming from third-party platforms. So that's now become very, very, very normal, right? And now the fact is that there are a lot of entities which are enabling embedded finance right now in the market through the API framework. There's also a standardization happening in the market, in a sense that if you look at the way Oken is operating, right? Oken is tending to standardize APIs, right? And there are a lot of players in the market like a Credit Avenue also helping in engaging with the market differently. So we see that trend that lending will also get completely API-fied. And we had written a concept of National Lending Corporation of India, which is again around building an alternative to NPCI in the lending domain, which can APIs. Matthew, can you just ensure that people are on mute? Okay, so the point is that a lot of platforms generically will have customer engagements layers generically, but for them, let's say you are on Amazon and you are on a Flipkart, or you can be on maybe Uber, and there maybe you acquire the customer for lending, right? Why would you do that? You can acquire the customer for lending because the merchant will get the benefit, right? Merchant may want to do some transactions with you, or let's say, for example, you are an edtech platform. I mean, ours is an edtech platform as well, and we do lending to our customers as well in partnership with, say, a Great Cost right now. So technically, for me, I originate the customer for our partners, and our partners actually onboard them on their own platform and journeys. Maybe if we are larger, we would have done on our own. So for the lender, what is the benefit? The cost of acquisition is zero because we get the customer. They only have cost of operations, saying that how to underwrite, how to do the process and all of that. It's good for, as a merchant, it's great for me because I'm able to sell more to my customers. Anybody who's looking at EMI loans and all of that, I think they can come on board and they can utilize the service. So we openly tell every client of ours that when you take our long-term course, you can actually use my partner lender. And so for me, it's a great thing. For lender, it's great, right? Because they are able to onboard and a slightly higher IRR, right? Because technically I'm okay, say, as long as I'm going to make margins on the business I do. So all merchants do that, right? So it's benefit for them, and the risk of default is slightly lesser because when you are on a merchant, you would want to, there are merchants where you would not want to default, right? Nobody would want to default on an Amazon or a Flipkart or a Swiggy or a Zomato, because if they block you, you're dead, right? I mean, technically, if you don't have Swiggy and Zomato, then you can't get food. So you wouldn't want to default. So definitely some reduction in this, and of course, better experiences, newer product can be built around that. And of course, it can be, we hear it as a buy now, pay later is one product on embedded finance. We hear about instant loans, EMI loans, MSMEs. We have been able to do MSMEs loans a lot on supply chain platforms, and payments has been there all over, right? Insurance, InsurTech is also, people like Discovery are building in the market, right? So generally great movement. And again, I will keep coming back that over a period of time, 40% of the retail lending, 40% of retail lending will, and which includes retail lending plus MSME small ticket loans. They will all move to embedded finance platforms. They will not be originated on the front end of the lender. They will not be originated on the platforms of the lender, be it digital or physical branches. They'll come from the platform itself, because that's where the customers are engaging, and they're moving because of COVID and other situations there. They know where to buy those products, right? That's what we personally believe is happening right now, will continue to happen. In terms of why it is happening, we all know that customers going digital, economy is obviously is growing a lot. People are on platforms, generically open APIs, banking as service, and all of that is available. So generically, it's positive. Technology, I mean, the way we look at it now, everybody is talking about Web3, right? So the movement is, the technology is driving like crazy, and people are and it's not possible in India to build a lot of these framework faster. Now also variables and other things are also coming, which will also help in embedded finance as well, right? For example, there's a lot of variables are now containing transaction framework as well, on a watch, on anything else. So technically, embedded finance will keep growing, and of course, government is also pushing for it in multiple ways. So any which way, that's not the agenda right now. And of course, we can give examples on payment side where maybe Zomato and Swiggy are enabling payments. And then of course, underlying can be banks, and underlying can be a platform like a Klarna. It can be, you can do multiple partnership to figure out you, and these are all, sometimes people shift, right? For example, Kota can be enabling on its own platform e-commerce services. So it's bi-directional. Anybody can do anything, right? So you need to, and of course, let's say when Flipkart does embedded finance or embedded payments, it needs to partner with someone else, right? So technically, for example, Flipkart for lending will partner with Axis Bank for transactions, or Amazon type partners with ICICI Bank for credit cards. So there's a great business happening there, and if you look at their balance sheets and profitability, both of them are very, very happy with these relationships, right? So if you look at maybe a platform like a car platform like a Car Jasoos, they're building it, and maybe Stellups, which you hear about. I mean, before yesterday, I read an article on Stellups partnering with DBS, and I'm so happy to tell that we were part of the journey of building this relationship as well. That is somewhere where you see the partnership, where, for example, Stellups basically enables digital lending for the on the IoT device for their customers. And on the back end, they have partners like DBS for partnering and receivable finance and other kind of products they can do. And they are also partnering with multiple lenders. Or the way maybe today players like Shopify and or maybe Scale Play and others are doing. So there's a lot of business happening in that segment right now. Insurance side, again, similar framework. If you look at people like Google Pay are getting into lending, Google Pay are also potentially opening FDs. That kind of stuff has already started well back in the market. And of course, even on the card side, a lot of people are issuing cards. Cards are again become more and more distributed in the market. So I think that technically all I'm saying, I'm not trying to push anything else. The collaboration is the way out. Even lenders need to have partnership as a key framework, because I believe that 40%. If we have a solution, okay, 40% of their business will happen on embedded finance. Similarly, for merchants, they can create an extra line of revenues. They can also give better experience to the customer. They can also ensure that the whole journey is built in such a way that onboarding and offboarding becomes much easier, right? So I think these are the values or benefits which we get on the framework. Everybody gets benefit. Customer is happy because he gets credit or lending or insurance on time. The merchant is happy because he's able to sell more, right? A lot of people are not able to understand that. Why would we merchant subvent? In most of the time, subvention also happens, right? Merchants pay for the credit, right? Because in my case, I give the entire subvention from my side, because that makes sense for me to sell more, right? So merchant is happy, and the lenders get better IRR, and they do not have to hunt for their customers. The customers are onboarded at a lower cost, right? So that's largely everybody gets benefited out of this framework, right? And if you look at use cases can be on health side, where maybe practical kind of entities can actually help them in onboarding services. And worldwide, there are a lot of platforms which actually help on health side, and maybe all health platforms can actually build it for out there. You have telcos doing it. I mean, today we anyway know that Airtel payment bank is nothing but a extension in the old way of the way the telcos were working, and therefore they are using the same shops also as a bank branches, and they're able to offer more and more smaller services, small ticket services as well. Insurance they can offer as well. So I think we see value, and which you already seen it in the market. I spoke about edtech is the one large area where people like Byju's and people like Goodly and others also upgrade and all will also get benefited by offering these services, because they can sell more, customers consume more, and customers will become happier as well as they learn, and maybe their jobs will also, scenario will also change. And of course, mobile is also, I mean, all vehicles, anybody in the vehicle, also GrabPay is a big one, or Gojek also was a big one, where they're not a tech company, but actually doing everything around that, including insurance, including lending, including everything else, right? So we have seen this growth worldwide in each of these segments. Now, to build it out, if you, and I'll pause for a moment, because now what we are going to talk about is how to go about building it, which is the crux of this session itself. Right now, I'm just giving you a thought process, but I'll come to the crux of the matter as we go forward. Now, let's say you are running your own company, and maybe you want to take help from the partners. So technically, you will want to offer in your platform maybe a lending, payment, and all of that service under the fintech umbrella. And maybe the way Zomato has built the entire team for from the fintech perspective. So this is a platform where the customer is. You can partner with platform like Open, which has a Switch platform, or maybe Just Pay, or you can partner with M2P, which just got funded even more today, right? You can partner with them or Setu to enable these services. These guys can give APIs and a lot of banking as service, and underlying can be a bank underlying can be insurance, underlying can be a wealth firm. So you can do this. And of course, if you are large enough, you can actually do a direct relationship as well with the bank. So when we are building these frameworks, we actually work with banks and NBFC, and they help them in going to market directly with embedded finance. So it can work with all ways. You can work with a partner who can onboard a fintech, or you can actually directly work with the fintech, or as a fintech, you can work with a platform like a Switch or a Tink or JustPay or somebody else or M2P, and then they can get you the platform, either the lender or the platform on the payment side or card side. This is how typically it works. Obviously, whatever I'm saying is exactly not true, because not everybody offers everything, right? So don't. I hope you're not thinking of each of these brands as a generic platform, but the framework I was just trying to tell that you can partner with some of them to offer it faster. You can get off the hook pretty fast. But at this point of time, I pause. I'll come to how to build. For example, if you have a payment platform, how would you build? If you are a supply chain platform, how will you build? So we will talk about how it is built in the market, and happy to take any questions right now, because the next steps are more of exact process steps you need to do to build a platform. Yeah. Happy to take any questions. You can send on your chat, or you can actually ask this question right away in the forum as well. Happy to take both ways.
I had one question. This is Dr. Satai.
Yeah, maybe you can quickly introduce yourself, put your video on, and just ask a question. Go ahead.
Okay, the thing is, it's difficult to put a video, but something is happening background. So the thing is, because of what is the key difference with when 5G is enabled? How you foresee the banking or fintech system is going to change? Because we have seen the fintech system for last 4 years, how it is going, and what is the major difference which you can foresee when 5G is enabled?
I think I'll keep my focus right now more on sort of embedded finance. I'm not going to get into tech, right? This is not the forum, but I think I'll keep it focused only on embedded finance. How do we build it, right? So there's a different improvement for it. I think 4G, 3G to 4G has helped, but I'm not the biggest expert on the technology side, how the telcos will change. So I'll keep myself focused on what I know best. I think there's some questions coming up. I think the question which has come up just now is how relevant do you think PPI has become as part of embedded finance? I think PPIs will play certainly a huge role because I think one of the things which government has done is they have increased the transaction pricing or other transaction amount for a PPI. I think it's moved up if you have full KYC. And also, they have allowed them to engage with the UPI framework. So my belief is that this suddenly opens everything. You are with a card, you can literally run a account on the platform, and on top of that, you can actually do more transactions, more volumes on top of that, and you can also do UPI debits and credits, and also you can do loans as well. So if you look at the way Slice works. Slice actually is built on, at least initial version was built on M2P framework, where they have just-in-time lending happening, right? So when the transaction will go through on the card, the lender will invoke the money, and then the transaction will flow, right? So technically, embedded finance has a lot to do with availability of PPIs and PPIs with new power of higher amount limit. And also UPI enabled availability will do a better job at it, and full KYC also ensures that there are no additional risks. So looks very, very positive to me as far as I can make out. Any other question anybody else has before I move to the next steps for how to build, and it can be again interactive, because this is what we have built right now multiple times with our clients, but happy to take questions, happy to take some deviations if you have done differently and you would want me to sort of even learn from you, right? Why not? Because nobody knows the truth in these businesses, right? So maybe I'll quickly go ahead and talk a bit. Let me see if there. Okay. I think the next question is coming from Mani. How does OCEAN framework helps in embedded finance? It does yes and no both. So structurally, OCEAN framework has been built primarily to to enable anybody to become an LSP. And Oken is obviously primarily focused on lending, not on other segments. So Oken is built primarily to ensure that anybody can become a lender by part, and as long as they have a Oken frameworks, APIs, and product frameworks followed, they can partner with any fintech in the market, right? So any lender in the market. So that's how it is structured. But I also believe that we would have the framework should have been more done from a RBI perspective, and maybe it was more closer to a single entity like an NPCI building for it, which is what I was saying. NLCI framework is required. But since it is not there, it has taken more time. But I do believe that it should accelerate embedded finance as such. Maybe we need a bit more focus and force from regulator coming in, government coming in, and maybe we need for market making some entity to come and build for it, because sheerly on purely market infrastructure, it may not get built. If NPCI was not there, UPI wouldn't happen. So maybe we need somebody in between. But yeah, I'm all for it, and I do believe that it's in the right direction. Okay, so I think let me just now talk about how to build for it, and let's go step by step. Now let's take an example of a payment platform, and it can be somebody else as well, right? Who's trying to get into maybe a BNPL, EMI on card, or insurance or something else, right? And we can do a step-by-step activity with any one of them. So your assumption should be there's a platform which already has customer transacting on it, and has previous history of some transactions on platforms as such, right? So some history of it. Now, what they would like to do is they would like to, based on that data, if they want to have a leverage on that data, they should be able to convert this into sort of credit offer, a credit score, right? So technically, let's say if on my platform customer has done some time transactions, some bit of history I have on me, something he has done on me. So I should be able to create a proprietary credit score. It can be done based on just past data which you have, or it can be done in addition to some other data. You can mix it, so you can have a proprietary databases and structures. You can also partner with public infrastructure and get some more data on that and build a sort of credit score which is proprietary by nature. And then with that score, with that intent, and then you are able to onboard the customer, you can go to the lenders and or maybe, and that can be starting point. You can go to lenders, you can go to maybe the payments companies, you can go to maybe insurance companies and offer those services in this structure, right? So so technically what you're looking at building a new business model, so you can see revenues out on top of these products. You can prioritize which product to launch first. You can actually figure out which lenders to work with, what is the kind of returns you make, and maybe you can also build a proprietary credit score as well, right? So that's largely the first thought process or requirements which typically come to us in our business. And what we do is we technically tend to help them in sort of things like maybe helping them in business models. We can help them in sort of and technically you should look at right lenders to come in, because while everybody says that I want to become a lender, but how do you get a lender who is not high on FLDG? How do you ensure there is a revenue on the table for you? You should also know your cost structure as well. You should be able to build your customer score, and you should also be able to prioritize with which merchant, which platform you can work, right? That's largely the first framework. Now, to make it happen on the platform, what you might need to do as a structure is first, most time, what happens is that you may not be looking at revenues on day one, right? So you may be ignoring your costs. But technically, we always tell our customers saying that, boss, let's figure out what is the fixed and variable cost structure for when you do this, right? You may need people, you need technology, you have bureau score, you may be doing KYC on your side. What all you need to do, at least we need to have a fixed cost as well as variable cost attached to the whole product which you are building, right? That ensures that you at least know the amount of losses you will carry if you were to carry, and at least you can, when you were to negotiate with your lender, you should know what you're doing. You should be able to build a sort of which kind of product you need to build, what the process. You should be able to build the step-by-step process, right? What is the journey of the customer will be, because at the end of the day, the customer journey cannot be broken, right? You can't say that I'm on XYZ platform and I had to step out and do something. So how do you ensure that we put a right process flow? And that process flow is also linked to, again, as I said, some bit of cost structure. How do we ensure that it's optimized? We call the right API at the right time rather than call it upfront. Otherwise, the cost, for example, if you were to pull up bureau score upfront, it'll be much more expensive. So how do you ensure that it comes at the right time? So if you were to have any rejection because of KYC or something else, you can actually do it upfront. You should know how to price it well, right? Different products. So maybe you have to have underlying framework of what kind of customer bases, what are the risk levels you have, what kind of cost structure you can get. When you go to a lender, what should be the ideal cost structure you should have? If it is different tenure, different framework, how do you ensure that revenue is shared in such a way that you are viable as an embedded finance player, as well as and which means that as a merchant you are profitable. Similarly, the way the lender should be profitable, and then the customer should be happier as well. So I think we need to find ways and means to do that. There are frameworks, tools which we sort of tend to build, and of course we also tend to make mistakes on conversion rates, right? So you need to have model that if you were to process 5 transactions, how many of them will be successful, how many of them will not be successful. Therefore, all rejections will have to be bloated and added to the cost of successful ones, because that's how, otherwise lenders will not pay for it and you will lose money. And finally, it's about building the rev structure. The other thing, the next step, when you do something on internal, that's the maybe typically exercise you should do upfront. But then immediately after that, you should put a framework for identifying the lenders. There has to be a framework to identify that, look, in the market, there are so many lenders in the market, right? So you can't go to everyone. You really can't spend that much of energy going to each one of them. So you need to have a framework of assessing, saying that, okay, there are in the market for this particular segment, we may have 20 lenders. Now, rating them on their API readiness, rating them on their books. Let's say if they are more on secured lending, less on secured, why are you wasting your time going after that? You also should also see their credit growth in last 1 year. Are they increasing the exposure or not? In terms of the tech skills, org structure, right? How's the org structure? Do we have the right contact points to work with? You need to end up, it's a time consuming activity, technically, I'll be honest, but that's what you need to do so that you don't end up going to the wrong lender and start wasting your time. You need to be able to reach the right levels, otherwise bottom up is never worked. In terms of then of course you need to ensure that you start working with them, getting introduced to them, finding the right kind of products to work with them, understanding that if it is large lender, they will focus more on ETB customer, right, existed to bank customer, whereas they will not focus on NTB, right? So when you go to NBFCs, you know that they will largely target NTB, whereas banks will typically target ETB. So you need to figure out a portfolio. How do you build different segments around that? And of course, it's an iterative process. When some of my customers say that can it be done in 1 or 2 months, not really. It does take time. It's an iterative process because you are expecting lenders to commit to you on maybe sometimes unknown products. They may also, while in RBS framework, they have clearly called out that FLDG is not permitted, but you would get hit with this request that how do you ensure that risk is also passed on both sides? So it does take time. It is iterative. The settlement cycle, how do you settle? How do you ensure the revenue share is also done on a daily, weekly basis? I think those are the things which are trickier, and we've seen people making mistakes, enough mistakes. So I think it will be good if you could sort of settle that out, how to build around that. Maybe at this point of time, I can keep talking, but I'll pause for a moment and take some questions as well, if there are any. Yeah, I see some questions coming up. Okay, so the question which is coming again from Bhushan is, how do enterprises, startups build proprietary credit score? Is it on top of bureau scores or maybe? So I think it's a mix of match, right? So the entities should actually work closely with bureaus for ensuring that they do a back testing on data. And of course, they have the wherewithal to build it. Of course, there are the other companies as well who help in building scores, and you can work on both sides. I think it's a framework which takes time, but you should ideally work closely with your bureaus to build it. And as long as you can afford it, if it's not, if it's too expensive, don't. But otherwise, I've seen bureaus very keen to work with these entities and progress, right? So yeah, I think I hope Bhushan, I've responded back. They need to use their own data. They need to give that data back, and that will help us in sort of figuring out what is the risk of that customer. Is there a way we can collaborate with them as well, right?
Sure.
Yeah. Bhushan, maybe you can quickly tell me from what is your background so that at least I have a context.
Hey, hi, Sabi. So, so I work for an early stage startup called Card 91, which is based out of Bangalore.
Okay.
And incidentally, I actually happen to be come from a bureau background. So I've worked with Experian for nearly 2 years. And we typically used to, build these alternate data or proprietary scores on top of the bureau scores. So the question was more to understand whether fintechs and enterprises, are leveraging this in today's day and age.
Yeah, they are rural. I think there's a lot of work happening in this segment. Lot of work.
Right.
Yeah. Okay. Anil's question is that everything in banking is broken down and offered by fintechs. What will be the role of banks? I think technically, I think let me put it like this, right? It's an evolution process, and I also believe that all fintechs want to become banks, right? Technically, all fintechs want to become banks. They start saying that we are best in offering one service, which is, let's say, payment or lending. But if you look at all payment players are now getting funded primarily for lending. Every lender is trying to figure out if they can issue cards and they can ensure that payment is also routed through them. And everybody wants to now become a BNPL. Everybody wants to become everyone, right? So technically, it's difficult to say what is the shape and size. But what happened to PSUs after private sector banks came, and then what happened to MNC banks when the private sector banks started scaling? I think it's a game of competition, right? So fintechs, my take is over a period of time will also get licenses for becoming a bank. They will acquire licensing of banks. Maybe they will buy banks just like that, right? Because valuation of many of these fintechs is actually way beyond banks' valuations. And given that the situation, they might just, if RBI permits, they might just be able to buy, right? So we need to know how it goes from there. But I'm very clear in my mind that it's a play for both right now. It's finally the guy who delivers will survive. If Nokia had to die, Nokia had to die, right? So if somebody is not efficient, it is all okay, right? I think, okay, just one sec. Any other questions right now? And Maitri, can you just send the link for feedback, right? We will plan more sessions based on your feedback. And of course, we'll share the deck back with you to everyone who will share your feedback back with us. So you will share it back. Yeah, I think then Manan's question is coming. What is usually the payout structure when you get other lenders on board, and what do they want in return? So look, finally, it's a breakup between breakup between what do you call it? There's always a initial fees which is involved, which is the processing fee. So what is the share between processing fee of a processing fee of on the platform? So processing fee can be shared between the platform and the lender. In many cases, this fee is completely taken by platform because they're saying that we are originated. Then the entire interest component comes. You can actually take some share out of that. Shorter the term, lower will be the take rate. Longer the term, higher will be the take rate. So you can figure out that way. And you can actually take it upfront, or you can be embedded in the lending cycle itself, saying that as and when the lender gets paid, you will make money out of it. So you can actually have a skin in the game. And it can also be, suppose if you're also helping in some other activities, including collection, or maybe on your platform blocking the customer if the payment doesn't happen, then technically there's a mix and match can happen. So you have ways and means to make money, and at least we know that in India, lending is definitely profitable. So you can actually make it work for you. So yeah. I think so the next question is from Chirag. How, I mean, I'm reading as it goes, so I may not be able to respond or get the right answer, but let me go attempt it. How can a TSP negotiate better in terms of high validity requirement from lenders, any alternative to it. I think technically it's all linked to the situation you are in, the number of transactions you can originate. So if you are on day one, if your transaction size is not so large, you may not have a choice, right? You have to live with with high FLDG and maybe illegal. I wouldn't say so, but you have to live with it. But you can also take it like this: that on day one, you may not get the right rate. I mean, assume that you are bringing 1 crore on the table, on the books, right? So how can you negotiate, right? Lenders are not looking at 1 crore as a if they can cite that over a period of time, you will be able to help them in building maybe 100 crore books or 200 crores books. Then it makes sense, right? If you are building such a small book, it doesn't make sense, right? So I think a lot of people I've seen get very upset with lenders saying that they are not getting right rates. But without volume, nobody gives, right? I mean, why would they work with you API integration if you're not going to build books? And I've seen a lot of fintechs who would not build books, but want to integrate with multiple entities and waste everybody's time. So technically, it's a game of size. And of course, there are ways and means to do it. It's also you need to figure out which are the right lenders for this work. Who will take that? Who's going to ready to take that exposure in that business, right? You get into gold loans, you have to go to right guys. If you are looking at unsecured loan, you have to go to guys who are not who have a good exposure to unsecured lending, who have great APS. So I think it's an iterative process. We have been sort of working on it for 3 years. So I know that somewhere initially we would also have challenges, but it's easier when you understand. And of course, you need to start with some product where you can scale and you have lesser impact on the APIs of the lender, right? Sometimes we ask for too many changes. Now, lender may not be willing to make those changes because too complicated. So can you start with something and then improve as we go forward, right? So yeah, I'll go forward with it. There are more questions coming up. And again, one more question somebody has come back is that how do you get access to this deck? Deck we will share if you guys can fill the feedback form. Yeah, so if you fill the feedback form, we'll know what you're looking at. And in some cases, we'll also have one-on-one meeting with you if that is what you're looking at, right? But that we'll see. Just one sec. Yeah. So I think so we were talking about these steps which we take. Day one, we basically have to get the model right. Once we get the model and cost structure and all of that right, we have to work with the lenders to ensure that we onboard partners. Now these lenders can be converted or replaced by, if you are trying to do insurance, it can be replaced by insurances guys. If it is payments, you can work on payments. If it's a new banking framework you want to build on top of your framework, you can go to only banks and build it up, right? So I think I'm just giving you a framework where somebody is trying on a payment side is trying to build a lending business, but it can be different for different segments, right? And of course, we spoke about a lot that you need to try to build your own scores because that will give you the leeway. You may have your own databases and data frameworks. If you are not using them, then lenders don't find you other than as an originator. They don't see much value other than you as an originator. But if you bring more data points, they'll be very, very happy. This is one of the reasons why all the merchants like Amazon has huge value in the ecosystem because they have really deep data. If they can't evaluate the data, how it is helping on the underwriting side, then lenders are not happy. So you need to be able to get that understanding as well. And of course, you need to work closely with the market data as well. If you can find market data, align with the market data. In terms of based on this, work closely with the bureau or work closely with the underwriting platform or some other agencies and ensure that you have a score up and running. You evaluate the score based on the back testing, based on bureau scores, scrubs you can do, and keep evolving with time, right? So you need to be able to nurture this data as we go forward. And of course, since it's a payment platform, you also need to work with the merchant and get the right merchants in. But if you are a merchant platform, obviously you don't have a choice. You are enabling, let's say if you are Amazon, you don't have that choice. You are basically enabling your customer. So since this was a payment company, we were doing merchant prioritization as well. But technically, you may not need to do if you are in the lender segment, right? So with this, I again. So this is what typically you will end up doing. You end up building a business model. You will end up creating a revenue model. You will be able to sort of Just one sec. Just one sec. Let me just get something off my table. It's making a bit of a noise right now. Just one sec. Just one sec. Yeah, I've got rid of that, so it works better now. Yeah. So you end up doing a business solution. You end up getting working closely with your with getting your banks in. You end up doing a analytics platform, and then you kick off, right? So ideally, you should be able to get all of these done in first 3 months. Technically, if you have a good volume, and then within next 1 or 2 months, you should be able to launch for it on the platform as well. And technically, what you should end up doing is you will have a deeper relationship with your customers, more revenues, and generally, as a lender, you will have higher disbursement. The risk which you carry if you don't do as a merchant is that you will lose potential customers who are looking for credit and not able to get it. If you are a lender, you will lose opportunity to be there where you should be. So most of the lenders who do not have great APIs are suffering, and they are not able to acquire new customers because these platforms do not talk to anyone who do not have a stable, a scalable APIs, right? So we do evaluate these lenders, and to be honest, we know which ones work, which ones don't work. So I think the market knowledge is ensuring that today only 12 to 13 such lenders are there who have decent APIs to work with for lending side, and they are the only ones who are gaining traction. Others are not. So I think there's a reason for many of these guys to actually get more aggressive, right? Similarly, I think we'll give you one more case where on a supply chain platform, you can actually build the use case as well. Very similar. So I won't say that it's too different. We applied this framework similar by nature. We were basically trying to let's say for a supply chain platform, you're trying to create a credit strategy. What you end up doing is you build a strategy, you get to the architecture, you need to build architecture as well. And then you need to get lender framework as well. So very similar, nothing exceptional. And the process is still the same, saying that you have to create a strategy, you need to have lenders, you need to build the architecture for that. And process is still the same. You need to build a strategy, get the right products which you want to go out in the market with. So what products you can get in, you have to evaluate also your customer base, right? A lot of times people don't look at your customer base really deeply. But getting the profile of the customer. So maybe you have 8 kind of profiles of customers. Each profile of customer has a different risk attached to them, different needs, different size of transactions they can afford. So getting that analysis is first one you need to do. A lot of times when we do it, the customer says, yeah, what time consuming is, but what we keep telling is that if you don't do that, what will we take to the lenders, right? If they don't understand the profile of customers, if we can't showcase who the person is, it'll be difficult, right? So we do that kind of framework upfront to ensure that you have a fair understanding of the customer base. You need to build build a framework for each entity in the market. And of course, you need to get the cost structure in. You have to have a revenue structure in. You need to build maybe you have to build a roadmap saying that, okay, there are 4 potential products there, but how do we build step by step? You need to build the entire journey. So typically you end up doing this in first couple of months, again, as usual. And the second step and third step are very similar by nature. You need to get the architecture in, you need to get the lenders in, you need to evaluate all of them and sort of work forward with them, right? So I think it is, if in some places where the technology teams are very strong, we have found that this whole process takes maybe less than 4 to 5 months. But tech team is not very strong, does take more time, more like a 9 months, because it does take some time to stabilize those, build those APIs and take forward. And yeah, so I'll not go further deeper into it, but technically what the impact is that the launch happens fast if you have a structured approach. A lot of time we have seen people bleeding because they don't have the framework upfront, profile and all, and they end up going to wrong lenders, and they end up going to maybe pure fintech lenders, right? And fintech lenders are far too expensive for them, and they will not be able to make money. So you need to be able to start potentially with fintech lenders, but gravitate towards a larger lenders as we go forward. Happy to take more questions as we do go forward. Just point that these kind of sessions, similar kind of sessions we take as part of our training courses. And the training which is coming up is coming in February. And we're just closing the last cohort where for the last 4 months, we have trained almost 50 odd guys. And they're very, very senior guys in the market, founders, CXOs. and they have learned how to build it, their own fintechs. They're building their own embedded finance business. Many of them are CXOs in their own banks as well, right? So they're also learning. We have a chief risk officer of a bank as well in our session. So I think what we will understand is how to run digital transformation. How do you build digital payment framework? How do you ensure that whom to engage, what to engage? And we, of course, in these sessions, we do bring seniors in the market and really top seniors, founders in the market, who will actually coach you on how to go about doing it. So it's almost every Sunday, it will run for 16 to 18 weeks. And we do help. I mean, this is very useful right now in the market. There's a third cohort which is starting and has been great for the participants. Many of them started their own businesses. Many of them have changed their roles within their own organizations, and many of them actually have taken new roles in other organizations. So you will get full understanding out there. It commences in February, and it's all experiential by nature. So a lot of sessions by us, but a lot of capstone projects are which need a lot of brain power for you. So if you want to, and it's all on Zoom, so online. Many guys are coming from across the country, not just across the country. We have people from other countries as well, including Europe, US, and Middle East and Southeast Asia joining us in this course. So if you are interested, please reach out to us, and you can also reach out to Srikanth as well if you are looking at participating in it. Of course, if you are looking at joining us or working with us in some consulting, happy to do that. But right now, any questions on embedded finance which you want to ask, I'll be happy to take that as well. So over to you. And let me see if I can see any question which I have not understood. Sandeep, I'm not able to understand your question. Can you ask your question?
Yeah, hi Samir. I think so. I was just going by one of the statements which you made, that if you are through a Zomato or Amazon and you're doing an embedded finance, you have the cover of deactivating or delisting that particular user. But my question is that legally allowed?
Okay, so let me ask one basic question.
So, or probably I have not understood the
so let me give a very basic question answer, right? I will not say legal term, but let's say if you come on my course and let's say my lender has lent you money and you don't pay the money, so lender is lost, right? And I have done the subvention. Now I'll block you from my platform, because otherwise we're not in the business that I'll get you lending based on, and I pay for the interest, and you will not join my course as well, and you will basically default, right? So, or you will continue my course, take the whole course, and you will not pay for it, right? So technically it's a judgment of the merchants. It's like the same thing, right? If you on a flight you misbehave with the flight, you will get debarred, right? So if you default, you are going to face this. So it's legally permitted. I'm not going to say that, but it's logically correct. And I'm not going to legal, but logically correct. If you don't pay for your services, you are going to be barred.
No. So what I want to know is there a market practice? Because yes, there are people who are doing lending through the Amazon here. Whatever my experience has been, okay, obviously I can't name, and I've worked with some of the things. You can't just kind of deactivate or delist that guy. Of course, it's debatable, okay, but because in that logic, most of the people will be on a geo network, and an Amazon, his life will be finished, if he just kinds of defaults in these two networks. But it's debatable, this thing. You can't, because you see, the marketplace is a facilitator.
Yeah, no. I think, Sandeep, it is linked to the situation you are in. EdTech courses will definitely bar you. That's how they operate. But there are other segments which are fine with it, because they want to continue to sell and they're okay with lenders to take the hit, right? So that's okay. But EdTech segment, a few segments are definitely of those.
EdTech can be, I agree, that can be possible, because then you sign up in the beforehand. That's fair. Yeah.
Okay. Depends on the platform.
Thanks.
Yeah. I think happy to take any more question. I think some of you are asking the cost of the course. I think Srikanth will get in touch with you. The brochure we will share with each one of you. So I'll not want to talk about the cost right now. Srikanth or some of my team members, so Anil, somebody will reach out to you and we'll plan. But any other question right now? I know I went very, very fast. maybe I'll also tell you the nuances where you can go wrong on embedded finance. So few pointers. I think we have seen in embedded finance, one big issue which has happened is that the platforms do not create a proper structure for fintech, right? So what happens is they end up creating a shared resource and very little cover for it. So what happens is that these frameworks do not scale with time at all, right? So you have built all of that, you have been able to get lenders, but scale never happens because technology team is not strong enough. You don't have enough of LOS, LMS platform or underwriting platform built, right? So it remains a half-baked stuff for too long, right? So I think one of the biggest mistake people have made is not to invest in the fintech framework properly. They believe that they can get away with shared services, but it doesn't work, has not worked till date. So if anybody is trying to build, please ensure that you properly align resources and money for it. Otherwise, you'll have your original business will be impacted because this segment will never scale. You will only have deviation and time wastage, right? So be aware. So that's first big issue which we have said. Second is, people do not look at the cost and do not look at the workflow and the process for it. So I think building those upfront, both from a process flow perspective, engagement layer perspective with the client, whose client it is the merchant going to own the relationship and engagement, or it will be the lender. I think these are crucial pieces. A lot of people leave the client directly to the lenders and do not engage with them at all. And they end up losing the customer on a long-term perspective because lender may actually try to cross-sell something right away. That's a big issue the merchant may have. So they need to be careful about it. And they need to create experience directly on that. That will be a good one for them. Third is they don't hunt for right lenders. So they end up offering higher rates for their customers, wrong rates for their customers. Maybe the products also not built correctly. So that may have a higher processing fee upfront and maybe a slightly more IRR as well. So ensure that those things are very, very well built. Sometimes we are not building whose role it is, right? What is the role of merchant and what is the role of lenders clearly, or a embedded finance player correctly? So building that up, documenting it as well in the agreement and all of that is very crucial. And this is something when we work with them, maybe the lender say, "Bahut zyada deep hai," but I've seen bad negotiation on reconciliation process later on. So it's always good to have responsibility clearly. Good to have the reconciliation done correctly on a literally daily basis. Do not make it wait for too long. So embedded finance may have seen a lot of people do not have that thought process that the transaction is actually money flowing in. And also maybe the security side, I've seen a lot of flaws happening because they don't, the embedded finance the platforms may not have that much of security because they are not built for finance, right? Therefore, the security levels are slightly lower. I think the moment you get into fintech, you need to get ready for it. So that's one more area where we have seen flaws, right? So I'm just talking from whatever I have seen in my experience as such, right? Maybe let me just, maybe Satish, your question is how will BNPL work? I think it's we can take offline somewhere because I mean maybe this framework is simple, but maybe I'll give you a very, very high level answer to that BNPL. BNPL largely works of the money of the merchant. So merchant pays for the transaction. So when you say 1 month buy now pay later transaction where you buy now or pay after 1 month, basically merchant pays for the interest and risk is taken by the platform itself, which is going to lend for you. Technically, BNPL starts with a small amount and then goes up. There are also players who are enabling BNPL for banks. Basically, banks' own customers can get BNPL on multiple platforms. You have seen, I think, Flex Money building that kind of framework as well. So there are players who actually are building BNPL for ETB, existing bank customer, and there are players who are building like a simple and all in the market for other kind of customers. And of course, given that last rush towards last 1 year on BNPL, everybody is either launching BNPL or a credit card. So that's where the market is running for. Let me try to answer one more question. The question which is asked is by again Bhushan is that do you think neobanks will eventually get into lending? And answer is yes, of course. What else can they do, right? What else can they do? So I think they have no choice but to get into it. And will they do it now? Will they do it later? I think I'll keep that point that some of them may take time because it's tough to do it on day one. So they will rather build the stack on the liability side first, CASA side first, and then get into lending. But technically, everybody will. All neobanks on the MSME side are getting into lending. There's no other way, right? How do you make money on it? Because the banks will not give you much money on the CASA account, and legally they are not permitted to part with any money any which way from float. Technically, they can't give you any money. So the issue is still there. So lending may you are permitted to do whatever. So there's a space for you to do what you want.
Thanks.
Any more questions, guys? I know I've gone really, really fast. We still have 4-5 minutes to go. Happy to take any more questions, anything else which has happened, which has come back. I think Lecombe was asking that who are the best company for embedded finance and BNPL. I think I won't really go exactly who's good or bad or ugly, but I think framework wise, there are, I think Flex Money is doing good job. In terms of many of these new age enabling platforms are coming up, which are also helping. I will not name because there's too much of competition that most of them are my friends, so it will not be right. But we can also obviously chat offline and do that. Yes, I'll not go exactly deep into it because it will be. I mean, many of them are in the call, so it won't look nice for me to give a feedback on that. But yeah, a lot of people are working on it. I think there's one more question coming is that you guys are not able to capture the details of feedback. So you can actually reach out to Shrikant, and his number is also there if you are looking at any kind of direct partnership with us or consulting with us. And of course, if you want to join our executive course, this is the, I mean, whatever feedback we've got, it is by far the best potentially in Asia, and it's all usable. The content is all built together with the market. So almost 50% of the knowledge is shared by the market leaders, founders, and investors. And rest 50 comes from our side. It's all experiential for us. Consulting and partnership and training is all same. We bring the same knowledge to all three, right? So that's how we rejuvenate ourselves. So everything which we are talking about is based on the experience we have seen in our 5 years consulting, and of course career before that, which we are using right now. So I think that's, if you want to join that, happy to have you. Do give your feedback across back to us, and happy to take now. With this, we have 3 minutes to go. I'll conclude now in maybe next 2 minutes. Few pointers. We believe, and I personally 100% believe that BNPL, embedded finance will become massive in the market. If UPI has 95% share, which is embedded payments, which is how it works on PhonePe and others, lending will go the same way. 40% lending will happen on the other platforms. And if as a lender, you're not ready for your debt, and if you are as a merchant, you're not building for it, and if you're large and you're not building for it, then you're not going to do a great service to your customers, because they will have bad experience on checkout, they will have bad experience on getting credit, and they may wean away to a newer segment. Right now, we are working with a completely fresh segment, which is on fuel, and it's so interesting to see that entire fuel industry is primarily on credit, and it's all on merchants giving that credit. And if it can be replaced by lenders, that will scale as well, right? So there's so much of placeholder out there, and I'm being honest that in last 3-4 years, while we have worked a lot on normal fintech as well, but embedded finance keeps us it's mind-boggling, right? Think about it. You work on somewhere on the car side, you work on fuel side, you work on so many other industries, and then you realize that the need was there, and fintech over a period of time will slow down and maybe get bought over. But most embedded finance will keep scaling up, because that's the original need of the customer, and that's where it will keep happening. So with this, I stop now, and happy to take any feedback. Please go ahead and share your feedback. I think many of you are asking for pricing of that product. Maybe Shrikant, you're there. You can want to take a quick response back to this. Many of them are asking, what is the cost and how does it work? Maybe you want to take that if you're there.
Yes, I'm very much there. Maybe I'll reach out to all of them. I'm just seeing at the sheet. in an open forum, let's not discuss because that's what potentially is what we do. But I'll reach out to them one-on-one.
Yeah, and we're starting in February end around that time.
Correct.
And we do have EMI structure as well. As embedded finance is what we do, but not that digital by nature, because we work with our Grey Question as a partner who takes care of it.
Yeah.
But yeah, that's what we will do. With this, we stop. Thank you, guys.
We also have a couple of people who have joined the session who are already joined in our program also. Arpit is there, Sitaraman is there, they've already enrolled also.
Okay.
That's a testimony of what we are doing. So I'll just reach out to the rest. I'll reach out to them one-on-one.
Okay. Thank you. Thank you. Thank you, guys.
Thank you.
Guys.
Thank you. Bye.
You